Let's get started. So welcome, everybody. We're so glad that you've taken some time out of your day to join us today. This is a presentation that is backed by popular demand. We did this, we covered this content, I think a couple of months ago now, back in July, I believe it was. And so hopefully, if you weren't able to attend the first time, you're here today, and we're glad that you've decided to join us. So before we get started and before we dive into the content, we're just going to take a second to introduce ourselves, talk a little bit about the company that we work for, and take care of a few housekeeping items as well. So to start, my name is Phil Briggs. I'm a financial planner and associate portfolio manager at PWL Capital. I'm coming to you today from my home office, which is just outside of Toronto. And as Janet mentioned, Janet, I don't know if you're in the Toronto area as well, but it is a crazy heat wave. I think we're going to touch about 40 degrees with the humidity today. So we're getting one last blast of summer before we head into fall. My co-host today is Jordan Carter. Jordan, why don't you say hi to everybody?
Hello, everyone, and thanks for joining for the webinar today. As Phil said, I'm Jordan Carter, a financial planning associate at PWL, and also kind of located in southwestern Ontario, so as part of that heat wave as well.
And we also have another member of our team, Nicholas Donovan, who's one of our associates. He also, I saw, said hello in the chat. He's going to be monitoring the chat today on Zoom. So if you have questions during the presentation or want any clarification on anything that we are discussing, feel free to post them in there. Nicholas will also share some links if we reference an article or a blog post or a YouTube video or something along those lines. We'll try to get a link into the chat as well. So feel free to use that function throughout the presentation. As for our company, so most of you are probably familiar with the fact that we do work at PWL Capital, but for those that are maybe less familiar, we are an independent Canadian wealth management and financial planning firm. We work closely with families across the country to help them manage and plan for any issues around their serious long-term money. Now, in addition to the work that we do with clients, we're also super passionate about increasing financial literacy for all Canadians. And so we produce a variety of different content, such as this webinar, that we give away for free. The best place, if you want to check out our content, learn more, dive deeper into any of the topics that we covered today, I would suggest checking out our website. It's just www.pwlcapital.com. There is sort of one place where everything is consolidated. You can find episodes of our team's weekly podcast, which is called the Rational Reminder Podcast. We also have a variety of different YouTube videos, blog posts, white papers on a number of different topics, things that range from, say, technical investing in the markets to the intersection of money, happiness, living a good life, goal setting. There's a ton of stuff there that you could spend hours and hours or days of your life going through. And so definitely suggest checking it out. There's a lot of great resources there.
And also, as Phil mentioned, Nicholas is going to be answering questions in the chat, but we're also going to be using a program called Mentimeter today as well. So this is going to allow us to get some input from you, the audience, and there's going to be some questions that will come through a few of the slides that we would love to get some input. So to get logged in, you can either go to menti.com and enter the code on the screen here, or you can also use the QR code if you want to get access on a mobile device. We will have this information kind of going forward too. So if you're having a little bit of time to get going, but yeah, we'll give you a minute here just to get logged in to Mentimeter.
And for those that have attended before, you've probably seen our presentations and know a little bit about the Menti software. For those that have never attended, I do want to highly encourage you to log into Menti and participate along with us. If you just listen to Jordan and I talk at you for the next 45 minutes, it's going to be pretty easy to check out, to check your email, something like that. We like using this software because we find not only is it fun and makes things interactive, it's also a great way to help you stay engaged throughout the presentation. So highly, highly encourage you to log into Menti and participate along with us.
Awesome. And maybe to begin with, we have a bit of a test question here just to make sure everyone's up and running on the software. So question should show up. Which of the following is not a real account type in Canada? So the couple options there: RSP, TFSA, IRA, and FHSA. Looks like some answers are coming in pretty quickly here, so that's great. People are getting logged in.
They're getting logged in and they are pouncing on the correct answer.
Yeah, they're smart audience today, so that's great to see. And as I said before, yeah, this information as far as menti.com and the code there will be on some slides too if you're taking a little bit of time to get logged in. But good job, everyone. I'll pass over to Phil to get kind of the overview of the presentation we're gonna be going over, and as well just get us started talking about this retirement journey we're gonna be going on.
Yep, absolutely. So the central theme of today's webinar is how to think about planning for your retirement, which I think is a great topic and one that a lot of people can find to be a little bit scary. I've been a financial planner for a long time and worked with people at all stages of life, and they all find retirement a little bit of a tricky subject to think about, to talk about. For people that are just starting out, oftentimes it can be hard to connect with a goal that's 20, 30, 40 years into the future. And for those that are closer to retirement or in retirement, it can often be scary, to think about things like, do I have enough? Am I going to be okay? Am I going to be successful in my retirement? And so my hope today is that your questions will get answered. You'll learn some valuable information. And ultimately, we've designed the content to try and answer common questions that Jordan and I hear as we work with people on their retirement plans. And so to start, we're going to talk about how tracking your spending today is an important part of planning for your retirement in the future. We're then going to transition to do an overview of the pensions or government benefits that most Canadians will receive in retirement, the Canada Pension Plan and Old Age Security. We're then going to talk about inflation, which is a topic that has been in the news, in the headlines quite a bit over the last couple of years. We've seen a recent stretch of very high inflation that has been a new experience for a lot of people here in Canada. And so we'll take some time to unpack that and how it affects your plan. We're then also going to take some time to talk about the 4% rule, which some of you may have heard of, maybe not everybody. It is a very popular rule of thumb that is out there, particularly related to retirement planning. And so we'll talk about what it is and whether it's a good rule to follow or not, whether it's helpful. And then finally, we're going to talk more about investing your portfolio in retirement and how you can protect yourself or bulletproof your plan against any downturns in the market. So those are our topics for today. To help sort of keep track of where we are in the presentation and sort of our journey throughout the content, I'm going to refer back to this diagram a couple of times, which I think is a simple depiction of what a typical retirement plan looks like. You can see on sort of the left side, the assets are increasing as we age over time. So when we're just starting out, our assets are low. As we save, as we build wealth over time, our assets increase. Eventually, we get to a point where we cross over that red line. We actually decide to retire, and we start to see our assets gradually decrease over time as we draw on them to fund our lifestyle in retirement. And the assets that we save for retirement are also going to be supported by Canada Pension Plan and Old Age Security, which themselves are also assets that provide a foundational level of income for Canadians in retirement. So we'll refer back to this a few times. This is where we are going to be going. And so let's dive into the content. And to start, I have an open-ended question here for the group. You can type your answers directly into Mentimeter. And what I would like to know from the audience is, how much do you think you need to save in order to retire in Canada? You signed up for this webinar today. Presumably you're coming in with some thoughts, some ideas. I'd love to know what you've read, what you've heard, what other people have told you. Feel free to type it in. Would love to kind of hear what the audience is coming in and thinking before we dive into this. So around 1 million, around 2 million, over 1 million, 750,000 right now, base off current spending. I'm just kind of shouting out some of the answers that are jumping out. Really depends on when you want to retire. Probably around 2 million question mark. I like that. I see a 25x spending. So there's someone who knows about the 4% rule. Jordan's going to talk a little bit about that later. That's a reference to that rule. Depends on your lifestyle for retirement. enough to generate 100K in spending cash flow per year for both me and my wife. Oh, we've got a very exact number to the decimal. I love that. Thank you for whoever submitted that answer. These are all great answers. Thank you everybody for sharing. I really appreciate it. So probably around 2 million. That one was my favorite with the question mark. So these are all great responses. I definitely appreciate the feedback. I would say that the way that I would tackle this question, and for all that this presentation is actually titled, "How much do you need to save for retirement?" In a lot of ways, I think this is the wrong question for us to be asking. I will suggest that there are two better questions that we need to ask ourselves when we start thinking about what our retirement plan is going to look like and how much we might need to save from our income in order to retire. So the first question is, how much will I spend? And the second question, which a few people mentioned that in their answers, it depends on how much you're going to spend. And the second question is, how much of that spending is going to come from my investment portfolio? Now, the reason that these are better questions is that the amount that you plan on spending in retirement, that's going to be the determining factor around how much you need to save. If we think about it intuitively, it makes sense that someone who wants to spend $100,000 per year, which again, someone referenced as their answer, I want to be able to spend $100,000 per year in retirement, that person is going to need to save more money than someone else who wants to spend only $50,000 per year in retirement. So these questions really are the thing that are going to determine how much you need to save. And there's no one answer that applies to everybody. So when we see headlines like this one that came out in February that throw out one big, scary, eye-catching number, the reality is that it really does depend on your situation. And it depends on how much you want to spend in retirement. And so let me give you a few examples of what this might look like in practice. These are different spending amounts in retirement and the amount that would need to be saved in order to hit these goals. So let's start with scenario number one. We're dealing with a 28-year-old couple who don't have company pensions. The only benefits that they're going to get that are not going to come from their savings are the Canada Pension Plan and old age security, and they're hoping to retire at age 65. Okay, if they decide they're going to do a bit of what we're going to call a no-frills retirement, they're going to live on $2,000 per month after tax. That's going to be their spending. The reality for them is that their retirement is going to be 100% funded by Canada Pension Plan, old age security, and potentially some other government benefits for low-income retirees. So they don't actually have to save anything as long as this no-frills retirement is going to provide them with a lifestyle that they're going to enjoy. Like hopefully at $2,000 per month, they like doing things for free, like going to the library or going out for some nice hikes, which I don't know, that doesn't sound too bad to me, Jordan. I like going to the library. But the reality is their spending is going to be relatively low, but they're not going to need to save anything. If instead your goal is to spend a little bit more in retirement beyond sort of the basic level of income that's going to be provided by the government, well, that's where you're going to need to save. If you're looking at spending somewhere like $40,000 to $60,000 per year, that's going to require a portfolio of something like $250,000 to $750,000 in savings. And if you're looking at spending even more than that, so over $100,000 per year, well, that's where we get into needing to have, you know, 1.7 million, definitely over $1 million in savings. And so you can see on the far right there, this shows for our 28-year-old couple how much they would need to start saving each month in order to achieve their goals by age 65. So somewhere in the range of $200 up to as much as $1,300 per month in order to achieve this goal. And so in seeing this example, I think a natural question that follows from this is, okay, so how do I determine where I fall, within these examples? How do I actually figure out for myself how much I'm going to spend in retirement? And I would say that the way to start figuring that out is actually to start tracking what you are spending today. So this will allow you to figure out what you're spending to maintain your current lifestyle, which is hopefully one that you're happy with and is bringing you joy. And this will provide a great starting point for you to figure out what you might want to spend in retirement. It's also going to help you figure out a couple of other things, like how much do you have available to save for retirement on a monthly basis? Like how much are you actually going to be able to put towards things like RSPs, TFSAs in order to start building wealth for retirement? Now, you can make a couple of assumptions when you think about your spending today versus your spending in the future. You can assume in retirement that most likely you'll be able to live on less than what you're making now, because ideally you'll be debt-free, so you won't have a mortgage payment or anything like that. What we also tend to see is that most retirees pay less tax in retirement compared to their prime working years because they're living on less, they're paying less tax. And then the other nice thing is that once you're retired, you actually don't have to save for retirement anymore. And so you don't need that additional income coming in for savings. And so to conclude this section, again, the two big points here are that your spending will determine the amount that you need to save for retirement. And if you start tracking your spending today, this will be a helpful starting point for you to figure out what you might spend in retirement, and then go from there to figure out how much you're going to need to save. Now, as I mentioned, the savings part is for the income that's coming from your portfolio. The government is also going to provide you with a nice foundation to get you started in retirement. And so I'm going to hand the ball over to Jordan, who's going to take over and explain some of the things that we need to think about related to Canada Pension Plan and old age security. So Jordan, take it away.
Awesome, thanks, Phil. And as Phil kind of mentioned there, we've looked at those expenses in retirement, and now the conversation shifts to the other side and looking up how are we going to pay for all these expenses that are going to be coming down in retirement. And looking at the screen here, we're going to start with two government plans. So we consider, as Phil said, that these are kind of any the foundation of any retirement spending strategy, and they are the Canada Pension Plan and old age security. They're two, both of these, government or income sources have a lot of complexity to how they are calculated, especially, considering that with the Canada Pension Plan. We're just going to give like a bit of a high level overview of these two, and look at really focus on the income that they can provide in retirement. So a couple of the examples might not include all the complexities, but again, just trying to get those general principles of that income that can be available in come retirement. And for the kind of kick off this section, we're just going to have another question here. So your Canada Pension Plan benefit is determined by your residency, your contributions, or the size of your investment portfolio. We'll give you a couple moments here to answer the question. We're coming in here now.
We might need to make these questions harder.
I was gonna say, it looks like the group is 2 for 2 in the multiple choice questions. So yeah, we'll let them kind of trickle in again. But yeah, everyone's right here that it is your contributions that will determine your Canada Pension Plan benefit. And with that, you really you look at contributing to the Canada Pension Plan or the CPP while you're working. These contributions are taken off your paycheck, similar to income tax. Unlike income tax, there is a maximum threshold. So for 2023, that amount was $3,700. So once you've kind of hit that contribution, you're not going to go above and beyond that. It is important to note that is the employee portion of that contribution. So your employer will also contribute on your behalf a similar amount. And that's important to note for anyone who is self-employed or thinking about going in that direction in the future, that if you do, depending on how you're getting paid, you will have to make those payments for both the employee and employer portions. And as I kind of mentioned before, we're really focusing on that income in retirement section of the CPP. And so kind of bringing it back to that, once you've contributed throughout your working years, there becomes a point where, you're getting close to retirement or you're in retirement, and you have to look at when are you going to start collecting CPP? So there is a maximum amount you can receive. So that maximum monthly benefit is just over $1,300 at age 65. So that depends on a lot of pretty complexities as far as how much you've earned over your career, and if you've had some low income years, or maybe you've taken some time off from the workforce, that number is going to be different for everyone. And this is really based off that the standard age of 65. So that's kind of the standard age. but you do have the ability to take your or start receiving your CPP payments anytime between age 60 and 70. But if you're going to take them before age 65, it's going to be a reduced amount. And if you defer past 65 up until age 70, you will get an increase in the amount you receive each month. So just give this some food for thought. But a lot of this comes down to with that kind of wide discrepancy. So, in that 10-year period, when should I start collecting CPP? There's a couple things that we look at, and we figured it would be just as easy to look at it. It's a lot of conversations or discussion happens about, oh, when should I take it? So we're just going to look at an example here of 3 retirees. So Joe, Nick, and Kevin, they each had similar careers, similar earnings, so they've kind of contributed to CPP in similar amounts over the years. But they each decide, they've all retired and they've each decided to collect CPP, but they're going to do it at different times. So Joe's going to start at age 60, Nick at age 65, and Kevin's going to defer until age 70. So you can kind of see the discrepancy or the range of amounts they're going to receive each month. Joe gets a bit less because of he's getting a reduced amount. Nick's getting a little bit more, kind of the standard at his age, and then Kevin's going to get an increase because he is deferring to age 70. And to kind of take this question or this example a bit further, we're going to show you a graph here which will show each age and as well as the total CPP lifetime benefit that each of these retirees have received. So you'll see Joe, Nick, and Kevin. Joe's the blue line there, so he's started to receive at age 60, but his contributions are kind of, because they're reduced compared to Nick and Kevin. His line is going to be that's a little flatter there across the page or the screen. Kevin, because of his increased monthly amount, it's a fairly steep line, but he's not receiving them until age 70. And you can kind of look here. If we look at each of their age 90. Joe would have received $238,000, Nick $312,000, and Kevin $357,000. So even with that deferring it and not receiving it for the first 10 years, he's going to receive quite a bit more than Joe or Nick. And one way I've used in the past is just an analogy to kind of think about this is kind of outside of the financial industry. If we take Joe and Nick and for example, say they're neighbors and both enjoy staying active. One morning Joe's gonna go out for a walk, and so he's gone out for a walk, and Nick decides half an hour later that he's also gonna do some activity this morning, but instead of walking, he's gonna go out for a run. So taking this example, you can kind of see that as long as they're in similar physical condition, Nick will catch and surpass Joe as long as they exercise for a long enough period. So you can kind of think of that as long as they're out there for long enough. And it's the same with the CPP lifetime benefits. So as long as their lifespans are long enough, Nick is going to receive a greater amount. And if you include Kevin in this example as well, he's going to leave well after Joe and after Nick as well. But instead of walking or running, he's going to be on a bike. So he's going a lot quicker, and he's going to pass them both. Granted, there's enough time. So the big takeaway from this and just looking at this decision is there is some benefits and to taking or deferring your CPP until age 70, and the longer your lifespan, the greater those benefits are going to accrue to you. So just something to think about as you're making these decisions. And kind of on the other note, we'll move over to the other benefit we talked about. So the old age security. So CPP and OAS are often talked about in tandem, but they're quite honestly, they're both very separate plans and are calculated quite differently. We talked about the CPP being based on the contribution, so it's kind of funded from those contributions. The OAS is actually just taken from the general tax revenue from the government. So it's something that it's just, you're not contributing to. And it's instead of being those contributions, it's actually based off the number of years you've been a Canadian resident. So as long as you've reached that criteria after your age 18, you're going to receive the maximum benefit. So you see here, the maximum benefit is just under $700 at age 65. One of the differences between, or I guess one of the similar things with CPP is that you can defer it. So you can defer taking it until age 70, but you don't have the ability to take it before age 65. So there's a slight difference in how that goes about. But again, it's something that one thing like this that also should be brought up with the old age security, because it's kind of just from a general tax revenue standpoint, it can get clawed back if your taxable income is high enough. So for 2023, that threshold was about $80,000. So once you start making over that $80,000, you start to have your old age security benefit clawed back. So you're going to be receiving a reduced amount. So just something to keep in mind as well. And we'll also kind of go through, we won't spend as much time on this one, but again, we'll go through a bit of an example with Joe, Nick, and Kevin again. So you can kind of see here, we're looking at 3 examples. So instead of being 60, 65, and 70, we got 65, 67, and age 70. So instead of being a 10-year span, it's going to be over 5 years that you can elect to start receiving old age security. And again, there's going to be different amounts depending on when you decide to start receiving your old age security. And again, here's the graph that shows the exact information from the CPP, but just from the old age security standpoint. And again, what we see here is, even with deferring it and not receiving it for those initial 5 years, you see Kevin, at age 90, receiving a greater amount than Joe and Nick. And again, kind of just looks at those the benefit you can see from deferring these benefits into the future. Again, and one of the things that we will note too, just with that old age security, is that it may not include the bump up that does happen at age 75. So again, goes into some of those complexities with these different plans, but the general idea being the same, that if you do defer to start receiving it, that there is a benefit from an overall standpoint. And again, I guess just some conclusions from this government pension part of the presentation is, again, looking at those longer life expectancies. It really makes deferring those payments and start receiving them at age 70 to be beneficial. And it can really kind of increase your overall spending in retirement. One thing to keep in mind is, if you are deferring CPP and old age security, you may need to find other sources of income for a period of time. We talked about deferring them until age 70. But if you retired at age 65, there's going to be a 5-year period there that you may need to pull funds from investments or other income sources to make sure that you're providing for your lifestyle. And one of the other benefits that we really want to talk about and kind of mention here is, if you look at both the CPP and the old age security, they both really provide a nice income. So there's a nice kind of again, that foundation. If we talk about the maximums, they're about $1,300 and $700, just to use ballpark numbers. So you're looking at $2,000 a month. So not an insignificant amount for income. And it's also important to know that those amounts are actually indexed to inflation. So as the prices of goods and services increase, you'll also see a bump up in those benefits as well, so helping keep pace. And that's a very valuable aspect or feature of these programs. And I'm going to pass it back over to Phil. He's kind of go over some of the importance of why we see that index to inflation, that feature, be so important with retirement income planning.
Yep, absolutely. Thank you very much. Let's actually just quickly check in on our retirement diagram here. So we have covered the initial accumulation years. The fact that, when you're thinking about retirement and you're building wealth for the future, you need to think about the amount that you plan on spending in retirement as being the determining factor around how much you need to save in order to be able to retire. And we've also covered the foundational amount of income that the government is going to provide in the form of Canada Pension Plan and old age security. And so we're now going to cross over the red line there into the retirement years and start thinking about some of the things that we'll need to consider once we're actually drawing down our portfolio in retirement. And as Jordan mentioned, the first thing that we need to think about is inflation and how inflation is going to impact our plan. And I want to actually start this section with another question. I want to make sure that we all understand what inflation is. Because I don't know about you, I find that when a particular topic like this gets talked about a lot in the news, not everyone necessarily knows what that means when we're talking about a particular term. And so, is inflation a measure of government spending, a measure of price increases, or a measure of economic growth? I like this group. Everybody just no messing around. They just get in there and jump on the correct answer. So you're exactly right. Inflation is a measure of price increases. And when we're talking about price increases, what we're talking about is increases in the prices of goods and services over time. So as the economy grows, we expect wages to increase over time. And as wages increase, that's going to lead to an increase in the prices of goods and services that we're going to purchase with those wages. And so here's an example of what this has looked like historically. I will say that this must be a US centric example because there's no way that coffee at Starbucks or even Tim Hortons costs only $1.85 today. I'm pretty sure it's at least, I haven't been to Tim Hortons in a little while, but it's definitely more expensive than $1.85. I'm going to assume that this is Dunkin' Donuts or, you know, a US chain, something along those lines, but it still does a good job illustrating the concept, which is the idea that a cup of coffee, let's say, cost only 25 cents back in 1970. And today it has increased in price by about 7 times that amount. And so for someone who retired back in 1970, they can't just set their budget for their daily cup of coffee at 25 cents and leave it there forever. They have to account for the fact that their coffee is going to get more expensive over time. And this applies also to groceries, clothing, housing, vacations. Anything that we might consume in retirement is going to get more expensive over time. If we go back to our previous example and we think about our no frills couple that was retiring and spending $2,000 a month, so $24,000 per year, the reality for them is they're actually going to need that number to increase over time in order to not lose what we call purchasing power, which is just a term for the amount of goods and services that our income can allow us to consume in a given year. And so again, I kind of make a point and then I can almost feel the questions coming afterwards. So I think the question that follows that statement is, well, how do I do that? Okay, you've said I need to increase my income throughout retirement. How do I make that happen? How do I stay out ahead of inflation in retirement? Well, I'll suggest that there are 2 main things that you can do. The first one is one that Jordan already mentioned, which is defer your Canada Pension Plan and old age security to get the higher amounts. Because not only are you getting a higher benefit, but those pensions are also adjusted each year. They increase based on the rate of inflation. And so they're going to go up throughout retirement as the cost of living goes up. And so if you can avoid it, don't take reduced amounts on these pensions. Getting a guaranteed pension from the government that's going to increase over time with the cost of living is a fantastic benefit. And so we don't want to sacrifice on that if we don't have to. Now, the second idea, or the second way to beat inflation in retirement, is to invest in the global stock market. Investing in stocks has historically been our best tool to stay out ahead of inflation. And so let me show you some history here. On this chart, you can see that inflation, so the gray section at the bottom there, inflation has caused goods and services to be about 2.25 times more expensive today than they were back in 1988. And over that same period of time, the global stock market has increased by about 15x, which means that any money that was invested in the global stock market, so a portfolio of stocks, has provided a significant return above the rate of inflation. Now, I want to take a quick pause and for clarification, I'm talking about investing in the stock market as a whole. There are a small minority of stocks that have had much bigger returns than this, and there is a vast majority of stocks that have underperformed the market as a whole. We're just talking about the entire market as a whole, all the good, all the bad. And I would not encourage you to play that game of trying to pick like, oh, which stocks are going to be the best performers in a given year and, you know, buying and selling and trading and moving things around. We're just talking about owning a small percentage of every single company in the market as a whole to try and capture the return of the total market. This is the thing that will give your portfolio the best chance of growing at a rate above inflation over the long term. And it's going to allow those dollars to retain or even increase their purchasing power throughout your retirement. And the reason that I want to highlight this and suggest this is an important issue is, again, in my experience, I would say that losing purchasing power or inflation risk is a risk that not many people necessarily consider when they think about their retirement plan. Oftentimes, I will hear people say things like, okay, I'm retired, so now's the time for me to start investing way more conservatively. Like, let's put my portfolio into GICs or even into a high interest savings account, especially now. Like, I've heard that the rates are really high, so doesn't it make sense to start investing in those kinds of products? And it's a totally fair question. The reality is that GIC rates and high interest savings accounts rates are very high right now, but inflation has also been much higher than what we've seen over the last while. And so you can see, on going back to the chart, like GICs, high interest savings accounts, those types of investments have provided returns that have pretty much lined up, maybe slightly exceeded inflation. And so they are therefore much more exposed to the risk of losing purchasing power over time compared to, say, a diversified portfolio of stocks. And so for the person who says, I want to invest in GICs now that I'm retired in order to lower the risk in my retirement plan, they're not actually lowering the risk overall in their retirement plan. All they're doing is trading off one kind of risk for another. They're trading off the short-term risk of experiencing some volatility investing in the markets for the long-term risk of losing purchasing power due to inflation throughout their plan. And so in retirement, you need to account for both of these. And you definitely need to account for the fact that things are going to become more expensive over time. You need to make sure that at least a portion of your portfolio is providing some growth in order to stay out ahead of inflation and maintain purchasing power. And so I hope that that is clear. Feel free to throw anything into the chat if you have a question or need any clarification. But that's our section on inflation. And we're going to transition now to talk about, again, this common rule of thumb that's been referenced a few times, known as the 4% rule. Jordan, take it away.
Awesome. Thanks, Phil. And to get everybody up to speed here. So yeah, we've talked about those expenses in retirement and how a portion of that will be covered by government benefits. So the next step is, where is the remainder going to come from? So for some individuals, they may have some very large or impressive some government pension plans that would cover the remainder. But for a lot of people, the spending does have to be provided and covered for by your investment accounts. So there's lots of rules of thumb that are out there related to retirement spending and investment portfolios at the time of retirement. And so we're going to touch on one of them being one of the more common ones being the 4% rule. And just to give you a bit of a background, the 4% rule became from a research paper by William Bengen, and he was a financial planner and wanted to determine how much his clients could safely spend in retirement. So there's nothing really kind of on the research front at the time he did this, and so he kind of took it upon himself. He kind of had the background and the knowledge to kind of perform these tests and these models. And kind of in practice, the rationale behind the 4% rule is that you can spend 4% of the value of your portfolio in year one of retirement. And then each year going forward, you can adjust that amount by inflation, and that portfolio will be enough to support you through retirement with a low probability of running out of money. So it's a very simple rule. So that's one of the big appeals of the 4% rule, is that it's a single number in the value of your portfolio, and it's at one point in time being retirement. So for an example, if you know that you need $40,000 of income in retirement in year one, the 4% rule is going to say that, okay, I need $1 million portfolio, and that's basically the sufficient analysis that you would need to do in that case. There are some concerns with the 4% rule. You'll see from the picture here, we actually had the opportunity of having William Bengen on our podcast, The Rational Reminder, that Phil had mentioned earlier there, back on episode 135. He was on with Ben and Cameron, and that aired back in February 2021, I believe. So they had a big chat about the original research, as well as how he works with clients in scenarios that maybe the 4% rule may not be suitable. I would definitely recommend it for anyone who wants to kind of do a bigger, deeper dive into that topic. They definitely go into a lot of the further details. For today's webinar, we'll kind of just touch on a few of those drawbacks that we see with the 4% rule. So you'll see here a couple listed. The first one we'll talk about is just the data or the research itself was done, or the original research was just done with US data only from a period of 1926 to 1992. So it's a very limited scope. So it's taking one market over one period of time. And kind of in that period of time as well, that was a very well-performing market. So it's very, it can be difficult to, confidently project similar market conditions going forward. And, you don't want to count on, those returns repeating themselves as well. So that's one kind of drawback that does happen with this. The analysis also covers a 30-year time frame as far as retirement is concerned. So, if looking at life expectancies, and a lot of people, looking at retirement, at earlier ages, 30 years may not represent the typical, or you may not represent everyone's, retirement and how long it will be. And because it is a model, it does have, a lot of assumptions that they have to make to produce it. So that includes even, taxes and investments and all these different assumptions that have to go into it. They might not match your situation, so it could make a lot of the analysis irrelevant. But one of the big things that we'll talk about here, give a bit more time on, is just the mechanical inflexibility of the rule. So, a lot of the simplicity of it that we talked about earlier, it's one number at one point in time, and in that, with that, it becomes very mechanical assumptions on your spending. So, we talked a little bit about it being, it's looking at your spending in year one and kind of just increasing it going forward. And for what we see with clients and individuals, that's not what happens, quite often, whether it be just individuals just spending less as they age, or maybe they, the 4% rule may just not be an accurate reflection of what happens in their life. So it kind of makes it, very, not applicable in a lot of situations. And another thing we see too is this, for a lot of individuals, they have a lot of flexibility in their spending. So if there's adverse conditions, whether it be market or elsewhere, people have the ability to, push a car purchase out a year, or, maybe spend a little bit less on a vacation in one year or not. Having that flexibility can actually increase the total amount of spending you can do in retirement just by, maybe not spending as much in one given year. And the 4% rule, with that simplicity, again, it really misses some of the complexities that are bound to happen in life. So, whether that be taking into consideration things like inheritances, or, pensions amounts that's starting at different ages. We talked about, deferring CPP and old age security until age 70, but if you need to know the value of your portfolio at age 65, it really brings a lot of difficulty within that calculation in applying the 4% rule in your situation. So again, a lot of the drawbacks of having that simplicity is it may not be applicable in each and every case. And because of this, the scenarios and the kind of the details that doesn't get included within the 4% rule, we recommend using more custom retirement plans versus these rigid rules of thumb. And Phil's I'll pass it over to Phil, back to Phil, and he's gonna go over some of these tailored plans and what we're looking at and how we go in evaluating them in client situations.
Yep, absolutely. Thank you very much. And actually, so I was glancing at the chat as we were going, and so Vic, John, and Phillips have all asked kind of similar questions about, so I'm saying that you need to invest, part of your money in the stock market. You've got to think about inflation. So how do we sort of gauge that? Like how much money should I have in stocks? How do I think about, potential volatility? And I'm so glad that these questions are being asked, because that's literally what the last section of the presentation is about. And I would say that it's probably one of the most common questions that Jordan and I receive when we talk with people about their retirement plan. Certainly last year, 2022, when the markets had a really bad year, a question that we got a lot was, hey, the markets are doing bad, my investments are down. How do I know if I'm still going to be okay? And so I want to introduce this next section and some of the ideas that we're going to cover with a question for the group, which is a simple true or false question. We'll see if everybody gets the correct answer this time, which is this: true or false? Two retirees with the same size portfolios and the same withdrawal rate will have the same outcome if they both average returns of 6% per year. Same size portfolio, same withdrawals from those portfolios, same average investment return. See, I like this. False started with a lead, and then a few people were brave to divert from the group. So for the two that said true, thanks for, not just following the crowd. Well done. Give a second if anybody else wants to answer. Inter-year performance matters. That's a comment in the chat there. Oh, perfect. One more person answered. Oh, we've got a few people going in on true. Okay, I like to see that. For all that I'm encouraging the people that are answering true, the correct answer is false in this case. But I like that we had a little bit of division this time, because I think it's a little bit of a tricky question. Like, we're probably all aware, maybe we're not, but of the fact that the stock market on average has appreciated over time. I mean, I showed you that chart going back to the late 80s that showed that on average, the stock market has gone up over time. But it's not a perfectly straight line up and to the right. It's totally normal for there to be years like there were last year where we have negative returns, even if the average return over a longer period of time is expected to be positive. It's going to be more like a squiggly line along the way. And so the challenge then becomes, when thinking about your retirement plan, is the fact that the sequence of returns that you receive is going to have a really big impact. And so let me show you an example again of what I mean by that. This chart shows us basically the example that we just outlined: two investors with the same value portfolio at retirement. They both have $1 million. And they're both planning on withdrawing $50,000 per year in retirement. And they're also going to average the same rate of return in retirement. Their average return is going to be 6% per year. However, there is one important difference between these two. So the investor on the left, we'll call him investor number one, sort of in the bluey gray section here. They started off their retirement with really, really good returns and then have bad returns later on in retirement. And what you can see is that even though they're drawing $50,000 per year from the portfolio, their portfolio is actually still growing because of the really good returns that they're receiving early on. The returns are so good that they're actually covering the whole $50,000 withdrawal, and the original principal amount that was invested is actually going up. So even though later on in retirement, investor number one here starts to suffer poor returns, at age 90, they still have $2.5 million left over, and they're probably going to leave their kids or their favorite charity a big inheritance. Investor number two on the right experiences the exact opposite. So they have poor returns early on in retirement, followed by great returns later. And what you can see is that the poor returns early on in retirement actually cause investor number two to run out of money early. Unfortunately, this is like, the example that you may hear of where the person has to go back to work midway through retirement in order to make up for some additional income. Now, the reason that I, again, want to highlight this is because all too often I have seen financial plans from other firms out there that people bring to me that just assume an average expected return throughout retirement every single year. So they say, okay, your plan assumes you're going to get 5% per year on average, but the way the calculation is done is they actually assume that the investments make 5% every single year. And what we can see is that this is a very dangerous assumption to make. We need to account for the fact in our retirement plan that the markets are going to fluctuate on a year-to-year basis. And so even if we're expecting a good average return overall, we've got to account for the fact that that's going to show up in a variety of different ways over time. And so the question again is, how do we do this? So at PWL, we account for this by running our clients' plans, their retirement plans, through what are called Monte Carlo simulations. So the way that this works is that we enter both the expected returns and some risk assumptions for their investment portfolio. So going back to the questions in the chat about, what does it look like if I have 100% of my money in the stock market versus 50 versus 20, we can actually run those different scenarios with different percentages invested in stocks. We then run hundreds of simulations of different retirements where the returns on the investment portfolios vary from year to year. So we essentially are, just to go back one slide, we're essentially recreating this chart only hundreds of times and looking at the results. And what we're looking at is the percentage of the time that our client was able to achieve their retirement spending goal versus the percentage of simulations where they would have to make some kind of adjustment in order for their plan to be successful. And the goal is to try and determine whether the plan is going to be successful, even if we run into a potential situation of poor market returns in the future. And so this is a way, by including these Monte Carlo simulations, that we can essentially bulletproof our clients' retirement plans against potential bad market returns in the future, because they're included actually as part of the plan. And so hopefully that's helpful. Hopefully that answers some of the questions that were there in the chat. I'm going to take a look in the chat in a second here. That concludes the prepared content for today, but a couple of other quick points at the end of our presentation. Number one is, if you think that this type of planning would be helpful or valuable for you, I want to let you know that I've actually specifically blocked some time in my calendar to schedule a call with anyone who attended today's webinar that wants to chat about their own personal situation. So you can actually click on the link that's there. And I believe Nick, I just see that Nick has posted a link to my calendar booking software in the chat. So if you would like to book a call, I would love to talk with you. Let's chat about whether there's an opportunity for us to work together. But even if not, no worries. I'll be happy to give you some free advice and try and point you in the right direction. And again, I'd be more than happy, especially for anyone that's attended the webinar, I'd be more than happy to meet with you. Second, final point is that we would love to get some feedback from you, the audience, on this presentation. We'd love to hear what you liked, what you didn't like, and also any suggestions that you might have for presentations that we could do in the future on other topics. We did a repeat today because this was a very popular presentation last time, and had a lot of people reach out saying they missed it. Where can I find it? Can you do it again? But the reality is we'd love to hear what you want to learn more about, and we'd be happy to build out a new presentation to give that to you. So feel free to click on the link there. It's just 3 questions, and please give us your feedback. We'd love to hear more. And so while that, this is just the last little compliance slide. I'll leave up the link to the feedback form there. And I'm now just going to quickly take a peek at the chat to see what's going on there. We've got 5.
A few, a couple new ones come in. I was going to say a couple new ones have come in, Phil, just as you were speaking there. So it looks like we do have a couple. Perfect. Is there any one that you'd like to, I've been chatting for a little bit, that you'd like to jump in and answer, Jordan? Well, I can speak to the CPP enhancements, and that's something I would say it doesn't change. It doesn't, I guess it's other than the differing amounts that will come from those enhancements. So if people aren't aware, there is the CPP is undergoing some enhancements, that the idea that it'll replace more of your income in future years than it is today. It is being very gradually moved out. So the idea being is you're not going to see, you're not going to have to contribute huge amounts of difference. You're seeing increases in the amount you're going to have to contribute each year, but it's being kind of dragged or increased over time. So not to have a huge impact in any one year. And as far as how they kind of factor in to our retirement income planning is basically similar to anyone who is going to receive different, CPP amounts. So it's all about, making some assumptions about how long you're going to be working at, in the workforce because of the complexity within just the CPP calculation itself. It definitely we rely on a lot of the assumptions that you're going to be getting from CRA and that type of thing, but it doesn't have a huge impact as far as making changes to retirement spending or retirement planning.
I just saw a comment that the link to the feedback form didn't work for somebody. I just threw it into the chat, so hopefully that works instead. Kimberly says, thank you, great webinar. Thank you, Kimberly, for attending. I wanted to grab one of the other questions too, that was from John. How can we consider DB or defined benefit pensions? Are they on par with CPP and old age security, so Canada Pension Plan? So it's a great question. There's a few things that you need to think about when it comes to defined benefit pensions. So number one, obviously, is that is going to be a huge chunk of your income in retirement. And so the question then is, what you're going to get from your DB pension, plus your Canada Pension Plan, plus your old age security, is that going to be a level of income that's going to provide you with a lifestyle that you'll be happy with? If so, you may not necessarily need to focus a ton on retirement savings. You're going to definitely want to focus on things like making sure that you're paying down your debt and you're debt-free in retirement, so that way that pension income that's coming in is not going to a mortgage payment or anything like that. It's just being used to fund your spending in retirement. You can also think about things like the second part of the question was, are they on par with CPP and old age security? I would say, yeah, it's another thing worth thinking about, which is, is this pension from my company secure? Is this something that I can expect, with a high degree of certainty to receive throughout my retirement? If not, sometimes when you retire, you can take the cash value of your pension and invest it yourself instead. I believe we've got some great articles. I'm not sure if anyone on our team has written one. Maybe I'll take that away and write the article myself around what should you consider taking the cash value of your pension versus leaving it with your company. But that's something else that comes to mind for me, is just how secure is that pension, Canada Pension Plan and old age security, because Canadians are contributing to them, because they're coming out of tax revenue. We do generally consider them to be pretty secure, whereas not every company. There are stories of companies that were paying a pension that then, the pension was underfunded, became bankrupt, and the pension went away, unfortunately. So definitely something to think about. We've got 1 minute left.
I think there's Nicholas had kind of answered the most. I think there was Nathan had a quick question. Just did the government not propose a change to 67 versus 65? And I think that was proposed with a previous government that was going to be enacted, but there was a change at the time. So that was going to be in the old age security. It was going to get bumped up from 65 to 67, but that did not get enacted. So
yeah, exactly right. Still age 65 for now is what the government is considering the normal retirement age. And John says, yeah, and yes, an article would be awesome. All right, John, you got it. I'll write the article. Okay. Well, it's 1 o'clock. Again, thank you so much for coming. If you didn't get a chance to book a call or give feedback, please feel free to reach out to us through the website. And this will, I think eventually there's a previous version of this on YouTube. Check out the other seminars on YouTube as well if you didn't get a chance to attend those, and look out on social media for future, webinar topics. Again, we're really glad you all attended today and looking forward to doing more of these in the future. So thank you, everybody. Enjoy the rest of your day. Take care. Thank you.